Coming up in today's show, stocks finished the week higher, led by tech posting its best day since May. All the latest bullish and bearish arguments. Are we going to get a Santa Claus rally? The latest commentary from a couple of billionaires. Moody's just cut US credit outlook to negative. I'll get you up to date what's going on in the bond and commodity markets. A look at how Q3 earnings season's been performing, and I'll get you prepared for next week. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. Hope you're all doing well this Friday, Saturday or Sunday, wherever you are in the world. And before we get stuck into the daily show, let me give you a quick introduction to those of you who are new to the channel. And just to be clear, I'm not a licensed financial advisor. I consider myself more a financial analyst and content creator. I do own 2 finance companies. I'm a designated professional investor from my government, broker and the exchanges. I have qualifications in the financial industry, having worked for Australia's largest investment bank. And I'm proud to say I haven't put on a suit for work in over 15 years. And my wife and I live down the bottom of the world in the beautiful Queenstown, New Zealand. And when I'm not staring at the screen, I prefer to get outdoors. And apart from trading and investing for myself, I also run the online business Click Capital and this daily market show. And for those of you interested, you can visit my website at clickcapital.io. And if you're wondering, the .io domain is from the British Indian Ocean Territory, a bunch of small islands in the Indian Ocean, as I consider Click Capital global business and wanted to run it from a global neutral domain. And on my website, you can learn a bit more about my products and services that I offer. I've got 22 custom indicators for TradingView that I use myself every day, which you'll see later on in this video. I've been a premium member on the platform for 9 years, and in that time, I've coded up a bunch of indicators that are now being used by almost 1,000 people around the world. I also offer a strategy called Only Bears, which you can follow along with real-time alerts, and that basically just holds a portfolio of 20 short positions in US stocks, and the performance is tracked independently by the Collective 2 platform, which I enter all my trades in real time for this strategy, and they track the performance minus brokerage and the cost to follow the strategy, which is $75 a month. And so far I've delivered my subscribers a healthy 40% return just from December last year, and I'm absolutely crushing the market year to date, up 33%. And on my website, I just added a new page recently called Presentation, in which I do a deep dive into my most recent investment into a small stock, a microcap I'm really excited about. I think it's my best pick all year. Has everything going for it. And thanks to everyone who's purchased this presentation, I've had a lot of great feedback. And for everybody else who hasn't purchased, I will share this presentation with you for free. However, only after my pick has gone up at least 50% in order to be fair to those who have paid for it. And so if you want to get it before it's too late, as I'm not sure how long I'll keep this presentation up for, it is a small stock with relatively low liquidity, so I can't have too many people following it, then head on over to my website, clickcapital.io, navigate to the presentation page, and you can get immediate access for $59, and that includes updates from me on the stock industry and my investment in it. And like I said, there's a few catalysts for this stock why I think it'll go up at least 50% in the next year. And is that guaranteed? Well, just in life, nothing is guaranteed in investing as well. However, is it one of the best risk-reward setups I've seen in my career? Yes, it is, and that's why I'm really confident in it and have put a significant portion of my long-term portfolio into it. So if you're interested in learning more about that, head on over to my website, clickcapital.io. I'll put the link below the video in this description, and go to the presentation page and check it out for yourself. Okay, just moving forward through the daily market show, and what a bullish day it was to finish the week out. We flipped from red yesterday to green today in a bullish kicker candlestick pattern, which I'll show you in the chart in a bit, and there was a lot of breadth out there, and once again led by the mega cap tech, having a stellar week, especially the semis. Clocked in some huge gains today, and pretty much green across the board. And just looking at the daily chart of the S&P 500 here, you can see yesterday we rejected off that trend line. Looked like we potentially may have reversed. However, today we gapped up, held, and closed above yesterday's high and this trend line. That's what's known as a bullish kicker candlestick pattern, as yesterday was bearish finishing on the lows, and today we have flipped it to bullish finishing on the highs. However, once again on low volume, which we don't normally see on a Friday. The strongest of the pack are the mega cap 8, which I track here in this composite chart. And tech had a bit better volume today, and the mega cap 8 as a group finished up 2.54%, the leading category out of all the indices we track. And we're not too far now from those highs made back in the middle of July. But stick with me throughout this video, because I'll dive back into the charts later and let you know whether I think that Santa Claus rally has started earlier this year. And the Santa Claus rally is a historical pattern that looks at a specific window of time that includes the last 5 trading days of December and the first 2 days of the new year. And 79% of the time the market finishes higher. And over the last 70 years, the average return in that small window has been 1.33%. And it's not just that week after Christmas that is a seasonally strong period. December as a whole is typically a well-performing month, and we can see over the last 32 years, the average return for December has been 1.5%, and the month with the highest win rate, with only 7 months of those 32 years finishing lower. And looking at a larger sample going back to 1964, we can see the same thing. Average return for December is 1.2%, and that's third only after April and November. We finish higher 71% of the time, that's second only to April, and the standard deviation is 3.5%, and that's only second to June. So in other words, it's usually a bullish month, we end up on low volatility. And those stats become even stronger when we're already up for the year to date. Starting November and October was down. And also considering we're coming off the back of a good Q3 earnings season, the market's becoming convinced that the Fed is done. There's plenty of reason to be bullish. That's why some are saying S&P 500 will test record highs next year as rising profits fuel a bull market. And that's research firm Carson Group, who expects the S&P 500 to deliver low double-digit returns next year thanks to rising profits. Their chief market strategist Ryan Detrick went on to say if we can avoid a recession next year, our base case, then we think the chances of a year with a potential low double-digit returns is quite likely. With them also saying, you know what tends to happen when profits are at a record? Stocks tend to follow, something we expect to see in 2024. And it's true, profits are rising. We're in a pre-election year, which is typically bullish. And we also just had a rare technical indicator flash a bullish signal as well. That's the swing breadth thrust. We get a sudden surge in the ratio of stocks advancing to the number of stocks declining over 10 trading sessions. Basically the pattern we've seen over the last week and a half. Markets flipped from bearish to bullish quite quickly and aggressively, and historically that's been a strong pattern and setup, with it only occurring 17 times since World War II. And out of those 17 times, the market's higher 100% of the time, 6 months and 12 months later, with average gain in the next 6 months being 15% and the next 12 months being 23%. And this is a strong setup that's in stark contrast to the macro backdrop, but the stock market and tech stocks in particular don't seem to care about these high rates. The stock market and analysts think we're not going to get a recession at all, and once again that's in stark contrast to what the bond market thinks. I myself are not too keen on large cap and tech stocks up here. I think most of the meat's already been taken off the bone. What I do like is small caps and micro caps, tiny stocks that have been beaten down really hard this last couple of years, and a record divergence technically and fundamentally on valuations with large caps. In fact, the earnings yield spread between small cap value stocks and large cap growth is near all-time highs. We've only seen it higher in less than 1.7% of the time. And whenever we've had this bigger spread, the 10 years following, small cap values returned a huge 16.8% a year more than large cap growth. And I've read a lot of financial academic research papers in the last 20 years. And one of my biggest takeaways from all of that is that valuations do matter, not so much in the short term. However, the price you pay for earnings will eventually catch up with you in the long term. And you can't just blindly overpay for earnings just because everyone else is. It's usually very hard to do well by following the crowd. And so at heart, I'm a bit of a contrarian, and I do my best to buy low and sell high. And we've got some bulls even becoming willfully ignorant. So even though we've got some strong recession indicators, you can pretty much ignore them, as the drivers behind each indicator are different than they were in the past, basically saying it's different this time. That's the SARM rule, which flashes when the 3-month average of unemployment rate rises 50 basis points above its low over the previous 12 months, and we haven't been seeing unemployment ticking up the last couple of months, something that I track regularly on this channel. And the inverting yield curve, we had a big steepening in the yield curve with the short-term rates stalling out and a bit of a sharp rally this last month or so in long-dated yields. And the stock market is very expensive, especially compared to bonds. However, just because it's expensive doesn't mean it can't get more expensive, and that's why people are saying it can still post impressive gains from this level. And that's something we've seen in history. When the Fed goes on pause, the stock market can keep rallying. It's typically when the Fed cuts rates that stocks fall, as they're usually responding to something that's going bad in the economy right in front of them. However, we've had long-dated yields fall for the last couple of weeks, and that's really helped to give the stock market a bit of a kick higher. Even though we had a weak treasury auction yesterday, helping to keep a little bit of a lid on yields for now. There's a lot of capital flowing into money market funds, as boomers and retirees can earn a safe 5% yield for the first time in 17 years. That's why we've seen a record 1.4 trillion flow into money market funds just this year. And we can see in this chart here, it's a little bit higher than what we saw in 2020. We got all that government stimulus and deposits at banks shot right up. But as you can see, the volatility in this chart here, we've also at this point of time got a lot of volatility in the bond market. With the VIX of the bond market, the MOVE index, currently at 116, we can see that's climbed off a really low base from late 2020 of 38. And just zooming out on this monthly chart, the only other sustained period of time that this was really high was back in the global financial crisis. And just staying on the monthly chart, switching over to stock market volatility, the VIX, you can see that stark difference in stock market volatility versus bond market volatility. And we can see that in the spread of the MOVE index versus the VIX. With it too, hovering around levels we saw before the global financial crisis in mid-2008. So what does that all mean? Basically, bonds are a lot more volatile than stocks, and you could think of interest rates as kind of like the whole foundation for financial markets. And so if the foundation of financial markets is moving around a lot on loose ground, stocks should eventually catch up with that, as the bond market's better at pricing the future than stocks, as it's made up of much more larger and sophisticated investors. And so like I said, the bond market is forecasting a recession next year, and the stock market and analysts are not. We can see that in Fed fund futures, with the market pricing in a 61% chance that the Fed will cut rates in May, and continue cutting them towards the end of the year, likely in response to a recession, even though the market's still pricing about a 1 in 4 chance the Fed may hike again in January. So if the Fed does cut, that should be a strong tailwind for bonds, at least short durations. And a lot of people claiming now's a good time to buy bonds. However, we've still got some others like billionaire investor Ron Barron saying he's never owned a government bond before, and that's due to rising inflation and the growing mountain of US debt. He estimates inflation could slash the value of money in half every 15 years, and that's why he always remains fully invested. And he's kind of implying that inflation is the only way the US government to get out of this, with him saying the way they pay it back is not the government paying down any debt. They pay it back by making your money worth less. And he's not wrong, because thanks to the Federal Reserve, there is an infinite supply of US dollars. There will always be structural inflation. And just looking at the value of the US dollar, that's lost 97% of its purchasing power over the last 120 years. And so I think a lot of people underestimate the risk of not being invested in assets that can grow above the rate of inflation, because that's basically the goal of investing, is to grow your wealth at a rate higher than inflation. Not helping the situation is we just got one of the world's top 3 credit rating agencies, Moody's, cut the US credit outlook to negative, citing rising interest costs and the large fiscal deficit as beginning to undermine America's credibility. Also, political polarization, Moody's said, raises the risk that successive governments will not be able to reach consensus on a fiscal plan to slow the decline in debt affordability. And this is something we're seeing showing up in long-dated bond yields and the Treasury auctions, because the US national federal debt currently stands at $33.7 trillion, and that's been accelerating this year and set to accelerate even more next year. Not to mention the long-term issue of over $211 trillion in unfunded liabilities, coming in at $628,000 per citizen, with current assets only a little bit higher than that at $653,000 per citizen. Long story short, US federal government is spending way more than it makes, and it's on an unsustainable path. Something will eventually have to break, or the Fed will bail them out with a huge amount of printing and subsequent inflation. At the heart of the issue is persistent gridlock in Washington, with once again the government facing a possible shutdown next week, with currently no clear plan to avoid that come November 17. And this is usually a nothing burger for the markets, because the markets kind of always assume that they'll always work it out the last minute, which they have done to date. But the more and more we do this, just maybe one of these times they don't, and that could lead to a bit of a quick meltdown across financial markets, as short-lived as it may be. Moving on from the bond market, let's take a look at commodities. Also helping stocks, in addition to falling yields, is the falling price of oil, which is the largest variable in inflation, and that's coming off due to demand worries and a potential supply surplus, much to the dismay of the Saudis and Russians, who are probably going to come out with more production cuts into next year to get the price of oil closer to $90. However, like with rising bond yields, a recession could also overwhelm that and bring oil lower, at least in the short to medium term. Already got a lot of weakness in the Eurozone and China. America's really been holding up the best, and we'll just have to see whether the stock market or the bond market is right next year and whether we get that recession come May or June. And there's a look at the daily chart of crude oil futures, getting a little bit of a bounce off the support zone at $75 a barrel. I'm just finishing the day a bit over 77, but we're still on a bit of a short-term downtrend here. We also had the recent safe haven trade of gold posting its first weekly loss in more than a month. After ripping higher from the conflict in the Middle East, we've seen a bit of a pullback and things kind of calmed down about that situation over there. Market's really not worried about it spilling over, and it's kind of already forgotten about it. And we can see that in the price of gold pulling back from this big resistance zone, keeps flirting with its all-time highs, and then just shying away from it. We actually touched the 50-day VWAP today at 1936 an ounce. And just putting some Fibonacci in there, on that recent swing higher, we've got the 50% retracement level around 1920 an ounce, with 61.8% down to 1900 an ounce, which is also an area of the market where we've stalled out before. So we'll be looking for some support around that 1900 level, and we could be in for some more sideways trading in gold. Moving on to cryptos, we saw a big rip in Bitcoin and more so Ethereum this week. On the back of news, the largest asset manager in the world, BlackRock, filed paperwork for an Ethereum ETF. And this is also after speculation that we're going to get the SEC approve a spot Bitcoin ETF, which has seen a huge rip in the price of Bitcoin over the last month. We now look to be holding above this resistance zone. We'll see whether we can hold above there next week and we turn that 35,000 from resistance into support. And just taking you out to a weekly chart on Bitcoin, you can see we're in the process of putting in a higher high. And just going to a daily chart of Ethereum, there's that huge rip up yesterday over 12%, but taking you out to a weekly chart, that's sitting right now in its resistance zone, which is around that 2100 level. So a break above 2200 would be another positive technical movement for the crypto market. We also got consumer sentiment data out today, falling again in November, with inflation expectations reaching their highest level since 2011. So a lot of us think prices are going to stay high going forward. And again, this is another contrast to the market, consumer sentiment falling. And we'll also get to look at the latest consumer price index, CPI, coming this Tuesday. That's been ticking up the last couple of months, but we're expecting that to pull back a little bit on the back of oil pulling back over the last month. So we'll be watching that one closely. We also heard from famous short seller billionaire Jim Chanos, his thoughts on Bitcoin, Tesla, AI, and he's a bit of a well-known bear on new tech. He even says you have to understand that the crypto ecosystem is well suited for the dark side of finance, which there's some truth to that. A lot of scams and dodgy stuff goes on there. I'm not too involved in crypto myself. I do have experience in it, and I like it for the fact that it helps keep traditional finance on their toes and a bit more honest with some healthy competition, which is already showing up in faster transaction times in normal banking. Jim's latest thoughts on Bitcoin spot ETFs is that retail investors think the asset price is going to go up. It's like a NASDAQ stock, not a currency, so they'll pay, and Wall Street wants the fees. Cost structure in crypto is quite high, and so the fees are really high. And that's true. When you look at transaction fees for some of the largest exchanges like Coinbase, like that, you can still easily pay 3-4% round trip, which is a huge fee. And once again, something a lot of people underestimate the long-term effects of. He's a famous long-term Tesla bear who once again focuses on the technicals, and his thoughts on AI is that it's a huge opportunity but also a big threat, just like the internet, which caused a lot of destruction and quick change, with him saying businesses we took for granted are no longer with us because of the digitization of products. I suspect AI will be similar. We also got billionaire hedge fund manager David Einhorn warning of a slump in stocks and potential recession in his latest letter, and he's pointing to the potential of foreign wars to drive up gas prices. Like I said, something the market's just recently forgotten about, but something he still thinks could disrupt global oil supplies at a time the market could be vulnerable with the low reserves, with low levels in the strategic petroleum reserve. Said if we get a spike in oil, that's going to squeeze the consumer, which could cause a recession and could also put the Federal Reserve in the uncomfortable position of having to fight rising prices at a time of rising unemployment, something Jade definitely doesn't want to have to deal with. And so to account for his view, he's positioned his portfolio in energy stocks, which he think could do better in that scenario, and give himself some dry powder if we do get that hard sell-off to take advantage of other distressed assets. And just looking at how Q3 earnings season's gone, it's coming a lot better than expected. S&P 500 is reporting year-over-year earnings growth of 4.1%. Coming into it, analysts were basically expecting flatline growth. For fourth quarter, they've actually downgraded, only projecting earnings growth of 3.2%. For Q1 next year, they're expecting an uptick with earnings growth of 6.7%, looking for that to accelerate into Q2 of 10.5%. We can see that in this chart here, Q3 this year going to Q2 next year. So, like I said, the stock market and analysts are expecting a return to growth in corporate earnings after coming off 3 consecutive quarters of contractions. And that's a big difference from what the bond market's saying. Because every time we get a recession, corporate earnings contract as well, as a lot of people are unemployed and can't do all that discretionary spending. Just looking out to next week, getting through the back end of Q3 earnings. Big one will be the CPI report on Tuesday. We'll get to hear from Home Depot on how the consumer is, along with Target on Wednesday, some retail sales data, and we'll hear from Walmart on Thursday along with jobless claims, and then just a little bit to finish out the week in housing. It was a real quiet week when it came to economic data. A real big thing was hearing from Jay Powell, who came out a bit hawkish. Sounded like he wanted yields to go back up, which we did see, and stocks sold off, but they seem to have forgotten about that today. And got some GDP data from the United Kingdom coming in a bit stronger than expected. And there's the consumer sentiment survey coming in a bit weaker than expected. The lack of breadth in the market's preventing the fear and greed index from climbing into that neutral zone. And corporate insiders increasing the level of trading in their own stock this week, with the spread between purchases and sales closing a bit. Sales are normally significantly higher. Yesterday, 144 to 107 purchases. Let's dive into the charts. There's the S&P 500 breaking out above that trend line. My institutional buying percentage indicator dropped slightly again today to 48%. We're almost back in that overbought zone on the S&P 500 oscillator at 57.8. But stick with me because I'll come back to this at the end of this video. First, I'll get you up to date on every other market out there. International stock indices, once again, finished a pretty quiet, flat week. Kind of mixed sideways trading going on. Typical VIX crash on a Friday, finishing just above 14. And a little busy day in the options market. 43.6 million contracts traded, 52% of them calls. And volatility risk premium is negative. Basically, that means the average implied volatility on near-dated at-the-money options is less than the actual realized volatility, which has been growing this last couple of months in the market after getting really low late July. Market's now trading at an annualized volatility of 15.6. A little bit of a pickup in breadth, almost half of stocks above their 50-day average. But once again, weakness in the amount of stocks making new lows versus new highs, with it being more pronounced on the NASDAQ, 122 stocks making new lows versus 42 new highs. And there's mega cap tech taking the growth versus defensive sectors, breaking out to a new year-to-date high. And the NASDAQ versus the Russell small caps, breaking out again to an all-time high. Big reversal on the spread of gold versus stocks after the Middle East conflict. It ripped higher in a safe haven trade, but like I said, the market's really not worried about that now. And we've got another increase in the 2-year government bond yield, now at 5.06, a bit softer in the long durations, the 10-year at 4.65, and TLT just calling up in a really low range day, low volume as well, and we could get a breakout either way here. Like I said, a lot of people think the bond market is bottomed, but there's a lot of things going on here, and that's kind of changing day to day. The dollar index coiling up as well, just below 106. We've already covered commodities, and over to stock sectors with cannabis ETF MSOS leading the way today, up 7%. Got a nice bounce off the support zone. We saw that positive development this week with Ohio citizens voting to legalize recreational marijuana in an overwhelmingly majority, and another sign to the Biden administration of what most Americans want. We're still waiting on the Safer Banking Act and the DEA to reschedule cannabis, both two big catalysts for this industry, along with President Biden hopefully making good on his campaign promise to federally legalize cannabis before the election next year. However, either way, this space is set to remain highly volatile, and we'll just keep hoping that the politicians do the right thing. After cannabis stocks, it was the semiconductor sector, the winner today, up over 4%, and just taking you out to a weekly chart on SMH, really close to all-time highs, above 160 here. And we'll be watching this one next week to see whether we stall out, as we are a little technically overbought, or whether we can keep powering through. The losing sector today was gold miners, down 1.2%, and the only other losing sector was clean energy. Just like biotech's been really hit hard this last couple of months and still a really volatile space. Nice little breakout in the BlackRock barometer, holding above its 50-day. And there's a look at the big guys: Apple, Microsoft, Google, NVDA, and Amazon. And you can see all those big stocks as well coming up to big resistance zones. My reversal signals indicator starting to fire off on them. And like we can see on Apple and Microsoft, we're looking a bit extended here. And so they've obviously been really liking that pullback in long-dated yields. So for clues on these tech stocks, just look at the 10-year yield. Tesla hanging in there as well, and Meta also at its resistance zone. And we've had a pretty good rally after those earnings down. We got some negative reactions. Once again, the market just flipped. Bit mixed across the meme space, but Intel finished up 2.8%. Another good rally in Sphere Entertainment up almost 5%. And Walgreens just trying to hold on to the support zone. And General Motors beaten down here. We did a bit of a small doji hammer, and I'm starting to see some bullish divergences on my DSI and a real strong one on the hidden divergence indicator. And either way you cut it, GM is cheap here. As in the last quarter, they reported $2.28 per share in earnings, and a similar level in the past 4 quarters, all coming in above expectations. And that's a huge amount of earnings per share for a $26 stock. And with a market cap at only $36 billion and clocking in sales at $156 billion last year, this stock could be very cheap when we look back in a few years. We're actually trading at the same level it was over 12 years ago. The stock's done nothing for over a decade. It's been so unloved. And of course, Tesla's been eating their lunch. However, with GM's market cap at $36 billion, and Tesla's market cap at $682 billion, even though they only do a little bit more than half of GM's sales, I think that huge spread is likely to close over the coming year or two, as Tesla's margins are pulling back towards industry averages. Other than that, we saw a little bit of rises in the financial banks, and they continue to hang in there. Okay, final thoughts on the S&P 500. Finished the day over 4,400 and above this trend line on low volume. Mega cap tech was the winner on a bit better volume, and small caps just kind of hanging in there. Finishing the day a bit high, but on low volume as well. So breadth is still weak, as we can see by new lows versus new highs. Stock market as a whole is really chill, with the VIX down here at 14. But bond market volatility and oil market volatility, not chill at all. They're still elevated. And so this market could easily keep running up and test the next resistance zone, which I've got around 45.20. And that's around the top level of the buy-sell band. So we could easily get up there next week. However, we'll be looking at CPI and how the market reacts to that. If that would come in a bit hotter than expected, we're likely to see a big rip in yields again. And just like we saw yesterday, stocks are going to react negatively to that. But earnings have been pretty good. It is a bullish seasonal period, so we have some pretty big opposing forces in the market. And I think all that could just lead to some more sideways action. And I suspect the rest of the year could just look something like that. But we'll just have to wait and see what happens. And if you'd like to find out what micro cap stock I've just recently invested in, and why I think it has the potential to go up at least 50 to 100% the next year, then head on over to my website, clickcapital.io, navigate to presentation, and just enter your email and safely check out. Leave the page open and you'll be automatically redirected to my 45-minute presentation. Like I said, I put a lot of effort and research into this. I think you're really going to enjoy it and find a lot of value, and you'll see why I'm so excited by this stock, which pays a quarterly dividend yield north of 10% and has the real possibility of being uplisted to the NASDAQ and NYSE, so big institutional investors can invest in it and we get a material repricing. Other than that, thank you very much for watching Click Capital. I hope you enjoy your weekend. I'm off to go do a hike, and I'll see all you guys again Monday night. Cheers.